The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Everyone wants to get the best mortgage rates, but beware of the terms. It could end up costing you more than you think. With me today is experienced mortgage broker Maria Dominelli from Invis. Welcome to the show, Maria.
My pleasure, Sybil. Thank you.
I'm so excited to have you here because we're going to learn how Canadians can save lots of money and make the smartest choices when it comes to their mortgage,
Good
right?
stuff. That's what we like to do.
So what's the biggest difference between a mortgage broker and a broker at a bank, or what do you call them? Just, I guess, an account manager.
Well, a lot of them call themselves mortgage specialists, and the mortgage specialists that are tied to the banks naturally would be selling the bank's products. So you're not going to get the choice of comparing mortgage products across the country. So it's really important that you not only visit your bank, but you also seek the advice of a mortgage broker.
To find out which is better.
Exactly.
How did you get into the business?
I actually was a banker prior to doing this, and rather than be moved around again, I decided this was a natural transition for me, and I just love it because 99% of the time I can find a lender suitable for the client.
Now, does it cost anything for the average person to work with a mortgage broker?
No, Sybil, it really doesn't cost anything to the average consumer to use our services and to have us actually shop over 50 lenders across Canada. And as I previously mentioned, it's important that they look at a variety of options because it's not all just about rate. Rate is extremely important, but there are other terms and conditions to watch out for as well.
So what are some of those terms and conditions?
Well, prepayment privileges are very important. So looking at one's current goals and long-term goals, how quickly do you want to pay this off? There should be flexibility with paying down your mortgage. The collateral mortgage versus standard conventional mortgage, and what are the pitfalls there? And if you do want to shop around when your contract is up, your term, then you could be facing several $100s more in costs to switch to another lender that would offer more if you're in a collateral mortgage. So it's understanding the pros and cons and the differences between the two things. So those are a couple of things that are extremely important.
And I would think, do most mortgages have portability options or transferability? Or again, are those terms you need to be mindful of?
Yes, you need to be mindful and not just focus on rate alone because life happens to people. 2, 3, 4 years into a term, you could be faced with an illness or a transfer with your job or a separation and all kinds of reasons why you need to get out of that mortgage. So if initially you're focused on that deeply discounted rate, but it's a no-frills mortgage that really has you strapped where you can't get out of the mortgage unless, for example, you sell the home. That's one of the conditions of some of those mortgages out there. So very important to understand and have a professional go through those terms and conditions for you.
So the lowest rate, no-frills mortgage, may come with some catches.
Handcuffs.
It's kind of like going on the airplane and getting a good deal, but you don't get fed.
That's right.
You got to pay extra for that.
Except it could cost you several $100,000s more in the long run. Another thing to be mindful of are prepayment privileges, prepayment penalties. So if you do find yourself where life throws you something unexpected.
In a good way, you got extra money.
Yeah, or you're having a family and you need to buy up. So portability is important, but what can you do with that mortgage? Can you blend your existing term and condition and extend the term if that would be favorable for you? If you actually, and I have a client right now who's been transferred and does not have enough equity in the home to sell and pay off his mortgage.
Wow.
So what is the cost of paying that mortgage out early? It's extremely important that you understand that some of the lenders that have posted rates and add the discount you got off the posted rate initially to your contract, they will add that to the penalty calculation.
And that can add up to thousands,
It can
can't
add
it?
up to thousands. I can give you many examples.
So when it comes to rates, there's lots of options there too. We've got fixed rates and variable rates and open mortgages and closed mortgages. Let's talk about fixed versus variable. Which one is more popular?
Well, I must say, if we're talking about the first-time home buyer segment, the fixed rate is more popular. And there's a few reasons for that. Number one is that you qualify on the contract rate. Typically, your first-time home buyer is going to have a lesser down payment. The minimum is 5. Hopefully, it's more than that. Your qualifying amortization is 25 years.
Okay.
Yeah.
You can't go beyond 25 years.
Not anymore. So that was one of the tightening up of the rules.
Yes.
So typically it's the 5-year rate that they take. Where you have a situation where someone has more risk tolerance, and that's another assessment in itself, and they can afford to ride the waves of paying an extra $100, $200 of payment when the rates do go up, and they may come down and go up. Then they may have a higher proponent to accept the risk of a variable.
Because the variable rates are usually lower than the fixed rate is, but the trade-off is the fixed rate, you know exactly what you're going to pay for 5 years, but the variable rate, you've got some uncertainty. So as long as you can stomach that, it may work out cheaper, but it may be more expensive.
It may work out cheaper, but if you're the type of person that's going to be watching rates every day and 2 years in, you panic and you lock in, and not all variable rates are equal as well. So very important that you look at the terms and conditions when you lock in. Some lenders only offer a 1% off the posted rate when you go to lock in. So again, rates, it's not all about rate.
They can get
terms
you
and conditions.
in all these other scenarios.
Yeah.
So how about open versus closed? What are the differences?
Open mortgages typically cost a lot more, and to be honest, lenders are not that competitive with open mortgages because, let's face it, sooner rather than later, they will be paid off. So your typical open mortgage is going to be priced higher, but it does give you the flexibility of paying it off at any time. So for example, you're expecting an inheritance in 4 months or 6 months, or something significant was going to happen. You were going to get a big lump of cash that is far greater than your prepayment privilege.
Right.
Then you might consider that. And we would go through those options. But your closed mortgage is going to be at a lower rate, but that doesn't come without penalty.
Okay, so that makes sense to look at. How about debt to service ratios? Those have changed a lot over the years. What do you suggest people manage to keep their debt service ratios within?
I think, rule of thumb is 30-40, depending on the situation. If there's money that is going to come in, and currently say there's a couple that are living off one income and servicing is tight, but in 3 months one of them is going back to work, then you might have a debt service ratio of 32 and 42.
So you really want to keep debt service ratios as low as possible to protect yourself in the long run.
Yes.
Well, Maria, there is so much more we could go through, but we're out of time. I really wanted to thank you for sharing all these great tips.